Hello and welcome from Trend Signal for our review of the data and events the week beginning the 21st of July. Last week was fairly appalling news, obviously, regarding East Ukraine and the downing of the Malaysian aircraft and also the escalating violence in Gaza. But despite the initial reaction late on Thursday, markets have managed to hold their poise and without showing too many signs of panic. There's an article in the Financial Times underlines one of the main reasons for this is that monetary conditions are loose, as is the case at the moment and has been for some time. Market volatility tends to be lower. As the Financial Times says, short-term interest rates are still stuck at zero. Real short-term rates are negative and companies are absolutely awash with cash. And they say, in other words, credit conditions are about as easy as they get. Looking at last week's moves, we can see that the FX markets are very much in the summer doldrums. Although it was interesting to note the pickup in the US dollar. This was partly down to the deteriorating business confidence in Germany and comments from Janet Yellen, the Fed chairperson, as she calls herself, that some asset valuations looked overstretched. She also warned that if the labour market continued to improve faster than the Fed had anticipated, then the first rise in rates would come earlier than now expected. The main reason, which is why we saw a pickup in the US dollar last week. Start of the week, there's a holiday in Japan on Monday. The rest of the markets in the Far East were mixed to low, but it appears that the initial concern from last Thursday has dissipated somewhat, although the markets are still a little bit nervous. European markets opened lower initially and will be driven by the political manoeuvring regarding Russian sanctions or the discussions about Russian sanctions. Markets most at risk are the German DAX, as Berlin continues to resist Europe-wide sanctions against Russia and its key companies and major oligarchs that are in Putin's inner circle. This paints a fairly weak picture, which is something the US, the UK and Australia find hard to understand, bearing in mind that the lives lost were predominantly European in this Malaysian air crash. Events this week dominated by manufacturing data in the latter part of the week. We look here on Thursday, the 24th. We have the HSBC manufacturing PMI for China, and then all the European manufacturing PMIs as well, followed up by the US flash manufacturing PMI as well. So a lot of manufacturing data out Thursday. We also have minutes from our own Monetary Policy Committee here in the UK, the minutes of the meeting held earlier this month. And let's just highlight that here. So it's the 9:30 on Wednesday. It's interesting because it'll be useful to see if there are any dissenters, as they're referred to, amongst the ranks of the MPC committee who might vote for some sort of preemptive rate rise. At the moment, the predictions are the usual 9-0 for maintaining the quantitative easing and keeping rates on hold. But in light of recent developments and expectations about the GDP data, we also have GDP, the first reading of the second quarter GDP in the UK, and the MPC may have some sort of insight into that. So the markets will be watching very closely what the MPC minutes show on Wednesday, and also on Friday when we have the release of the first reading of the second quarter GDP here in the UK. Expectations range actually from 0.8%, which is the same as the first quarter, up to 1%. There are expectations for a firmer number than this, I believe. In Germany, we have the influential Ifo Business Climate release. This is on Friday at 9 o'clock. We're expecting an unchanged figure, really, but the markets will be watching this very closely to see what effects the Ukrainian crisis is having on business climate. So that number we've closely watched and will have an effect on all the Euro FX markets and indeed bond and equity markets in the Eurozone. In the US, the key bits of data are the manufacturing data on Thursday, as already mentioned, and also inflation and housing data on Tuesday. Inflation is out at, let's just have a look here, at 1:30 on Tuesday. We did see a jump in prices the previous month, down to a fairly sharp rise in food prices, but we're expecting the core rate to slip back a little bit to plus 0.2%, which hopefully will allay any fears of inflation picking up. And I think whilst it has been a concern, I don't think that's going to cause the markets too many problems. Existing home sales on Tuesday as well, after what was a 3-year high the previous month. We're looking for a further rise here to 4.98 million units this time. So a buoyant US housing market for the time being. Finally, the other bit of sort of main data out this week on Friday, we also have the core durable goods orders, which is a very good pointer to the strength of the markets and the consumer. It excludes the really big ticket items, and that is showing a rise of plus 0.6% after a flat reading the previous month. So all eyes will be on what's happening in Gaza, what discussions are taking place regarding sanctions that could be imposed on the on Russia, and obviously any other developments taking place there. For the time being, the US dollar remains reasonably well bid, but I think the key sort of level around the 135 level on euro dollar is key. Sterling remains strong on the crosses, and expectations for a rate rise will keep sterling fairly firm. At least that's what expectations are for now. Good. Thank you very much for listening. We reconvene again on Thursday at 8 o'clock. Bye for now.
If you would like more information about trading the right way, Trend Signal is giving you the opportunity to see and hear about its services live at a free online seminar. Take a look at the Trend Signal website for the latest events and to book your free place.